You know, I've spent my entire life studying numbers, and I can tell you something with absolute certainty. The most dangerous numbers aren't the ones you see coming. They're the quiet ones, sitting in the tax code, waiting to ambush you when you least expect it. Right now, there are two specific numbers that could be costing you thousands of dollars every single year, and the odds are pretty good you've never heard of them. $15,960 and $21,640. Now, I realize those sound completely arbitrary, like someone just pulled them out of thin air during a budget meeting back in Washington. But here's what nobody's telling you. These aren't just random figures. These are the exact income thresholds that determine whether the government is going to tax your Social Security benefits, and depending on where you fall, you could be handing over up to 85% of your benefits to the IRS without even realizing why. The truly infuriating part? These thresholds haven't been adjusted for inflation since 1983. Let me say that again. 42 years without a single adjustment, while everything else, your groceries, your medicine, your rent, has gone through the roof. This isn't an accident. This is by design, and it's time someone explained exactly how this trap works and what you can do about it. I've spent decades studying human behavior and financial systems, and one thing that never ceases to amaze me is how the government creates these invisible tripwires that can completely change your financial life, and most people walk right past them without even knowing they exist. Today we're talking about two specific numbers that could be costing low-income seniors thousands of dollars every single year. And the tragedy is that nobody's really explaining this in plain English. We're talking about $15,960 and $21,640. Now, I know what you're thinking. Those sound like random numbers pulled out of thin air. But let me tell you, there's nothing random about them whatsoever. These are the income thresholds that determine whether you're going to pay taxes on your Social Security benefits. And here's where it gets interesting. Most people think Social Security is tax-free because, after all, didn't we already pay taxes on that money when we earned it? Well, that's what common sense would tell you, but common sense and tax law rarely shake hands. The reality is that depending on your total income, anywhere from 0 to 85% of your Social Security benefits could be subject to federal income tax. Let that sink in for a moment. 85%. That's not a typo. Now let me walk you through how this actually works, because understanding the mechanics of this system is the only way you're going to be able to do anything about it. The first number, $15,960, applies to individuals filing as single. The second number, $21,640, applies to married couples filing jointly. But here's the kicker, and this is where people get confused every single time. These aren't your gross income numbers. They're not your adjusted gross income either. The IRS created something special just for this calculation, and they call it your combined income. And combined income is calculated in a way that catches people off guard. Your combined income is your adjusted gross income plus any non-taxable interest you're earning, plus half of your Social Security benefits. Think about that for a second. They take half of your Social Security and add it to your other income just to figure out if they're going to tax your Social Security. It's circular reasoning at its finest, the kind of thing that would make a logician's head spin. But that's how the system works, and you've got to play by their rules whether you like them or not. So let's say you're single and your combined income is below $15,960. Congratulations, you're in the clear. Your Social Security benefits are entirely tax-free. But the moment you cross that threshold, even by a single dollar, up to 50% of your benefits become taxable. And if your combined income exceeds $34,000 as a single filer or $44,000 as a married couple, now we're talking about up to 85% of your benefits being subject to tax. The progression is brutal and unforgiving. Now, here's what really gets me about this whole setup. These thresholds were established back in 1983 and 1993, and they've never been adjusted for inflation. Not once. You know what $15,960 was worth back in 1983? In today's money, that would be something like $45,000. So what Congress did, whether intentionally or through sheer incompetence, was create a system that automatically pulls more and more seniors into the tax net every single year without ever having to vote on it. It's a stealth tax increase that happens automatically, and it's absolutely brilliant from a political standpoint because nobody has to take responsibility for raising taxes. Inflation does all the work for them. Let me give you a concrete example, because abstract numbers don't mean much until you see how they play out in real life. Say you're a widow and you're collecting Social Security benefits of $18,000 a year. You've also got a small pension from your late husband's employer that pays you $8,000 annually. Maybe you've got a little savings account earning $500 in interest. Your adjusted gross income is $8,500, which sounds pretty modest, right? But for the combined income calculation, we add that $8,500 to $9,000, which is half of your Social Security, giving you a combined income of $17,500. That puts you over the $15,960 threshold, which means up to 50% of your Social Security benefits are now potentially taxable. The actual calculation of how much is taxable gets even more complicated, and this is where the IRS really shows its creativity. They don't just take 50% of your benefits and slap a tax on them. Oh no, that would be too simple. They use this formula where they look at how much your combined income exceeds the threshold, and then they tax the lesser of either 50% of your benefits or 50% of the amount by which your combined income exceeds the base amount. It's designed to be confusing, and it works exactly as intended. But here's where this gets even more insidious, and this is something I want you to really think about. The people who designed this system knew exactly what they were doing. They set these thresholds at levels that seemed reasonable at the time, knowing full well that they'd never be adjusted, and that over time, more and more middle class and even lower income seniors would get caught in this net. It's the same principle as bracket creep, where inflation pushes you into higher tax brackets, even though your real purchasing power hasn't increased at all. But in this case, it's even worse, because these aren't brackets that move. They're fixed walls that more people slam into every year. Now, you might be wondering why this matters so much for low-income seniors specifically. After all, if you're really poor, you're probably not hitting these thresholds anyway, right? Well, that's where the situation becomes truly perverse. What often happens is that seniors who are living on modest incomes try to supplement their Social Security with part-time work. Maybe they're working at a grocery store or doing some consulting in their field. They're trying to be responsible, trying to make ends meet without being entirely dependent on government benefits. And what's their reward for this industriousness? They cross these thresholds and suddenly find themselves paying taxes on benefits they thought were sacred. Let's run through another scenario. You're 68 years old, collecting about $20,000 a year in Social Security. You take a part-time job at the local hardware store that pays you $12,000 a year. You're making $32,000 total, which doesn't exactly make you wealthy. But your combined income for tax purposes is $22,000 from work plus $10,000, which is half your Social Security, giving you $32,000 combined income. You've blown past that first threshold and you're approaching the second one. Now up to 50% of your Social Security is taxable, and if you work just a little bit more or get a small raise, you'll hit that 85% taxation level. The marginal tax rate on that additional income becomes astronomical when you factor in how it triggers taxes on your Social Security. This creates what economists call a benefits cliff, where earning an extra dollar can cost you several dollars in additional taxes and potentially lost benefits from other programs. It's the same problem we see with welfare programs and Medicaid, where the system accidentally punishes people for trying to improve their situation. And these are the people we should be encouraging. These are seniors who could just sit at home and complain about not having enough money, but instead they're out there working, contributing, staying active, and the tax code penalizes them for it. It's backwards and it's wrong. Now let me talk about strategies, because understanding the problem is only half the battle. What can you actually do about this? First, you need to know exactly where you stand. Get out your tax returns and calculate your combined income. Don't guess, don't estimate. Know the number precisely. Once you know where you are relative to these thresholds, you can start making intelligent decisions. If you're close to a threshold, sometimes it makes sense to be very strategic about when you take income. Maybe you delay selling that stock until next year. Maybe you take a smaller distribution from your IRA this year and a larger one next year when your situation is different. Maybe you bunch your charitable donations into 1 year to get over the threshold for itemizing deductions, which can help offset the tax on your Social Security. These are the kinds of tactical decisions that can save you thousands of dollars, but you've got to know the terrain first. Another strategy that works for some people is converting traditional IRA money to a Roth IRA before you start taking Social Security. Yes, you'll pay taxes on the conversion, but then that money grows tax-free and comes out tax-free in retirement. And critically, Roth IRA distributions don't count toward your combined income calculation. So you're removing a future tax landmine from your financial plan. Of course, this only works if you've got the money to pay the conversion taxes and you're doing it early enough that the math works out in your favor. Geographic arbitrage is another consideration that people don't think about enough. These are federal thresholds, but state taxes vary wildly. Some states don't tax Social Security at all. Others fully tax it. If you're on the margin financially, sometimes the difference in state tax treatment alone is worth considering where you live in retirement. I'm not saying you should uproot your entire life over taxes, but if you're already thinking about relocating, it's a factor worth weighing seriously. What really gets my goat about this whole situation is that it didn't have to be this way. Congress could index these thresholds to inflation tomorrow if they wanted to. It would be a simple fix. But they won't do it because it would cost revenue, and neither party wants to be seen as cutting taxes for retirees when there are competing priorities. So instead we have this slow-motion disaster where every year more seniors who can barely make ends meet are getting hit with unexpected tax bills. And here's the human cost that nobody talks about. When you're a senior on a fixed income and you suddenly get a tax bill you weren't expecting, that's not just an inconvenience. That's rent money. That's medicine money. That's the difference between eating properly and stretching every meal. The financial fragility of seniors in this country is a national disgrace, and these tax policies make it worse. We tell people their whole lives to save for retirement, to be responsible, to plan ahead. Then when they get there, we change the rules on them and tax benefits they thought were secure. The really maddening part is that this entire system is so unnecessarily complex. Why do we need this elaborate combined income calculation? Why do we need multiple thresholds with different taxation percentages? If we're going to tax Social Security benefits, and reasonable people can disagree about whether we should, at least make it straightforward. Have one threshold, one rate, and adjust it for inflation annually like we do with almost every other part of the tax code. But simplicity isn't the goal here. Complexity serves a purpose. It obscures what's really happening and makes it harder for people to plan effectively. I've watched this play out over decades now, and what strikes me is how little attention it gets compared to other retirement issues. Everyone talks about whether Social Security will be solvent in 2030 or 2040. Those are important questions, but right now, today, millions of seniors are getting hammered by these taxation thresholds, and it's happening in silence. There are no protests, no advocacy groups making noise about it, no politicians campaigning on fixing it. It's just this quiet, grinding injustice that compounds year after year. The lesson here, if there is one, is that you cannot afford to be passive about your finances in retirement. You've got to understand these rules because nobody else is looking out for your interests. Not the IRS, not Congress, not even most financial advisors who frankly should be explaining this better to their clients. These thresholds exist, they're not going away, and they will affect your tax bill and your quality of life in retirement. Knowledge is the only defense you have, and even that's not always enough when the game is rigged against you from the start.